Welcome, everybody. This is Brian Christie. I am the 2024 president of the Crowdfunding Professional Association, and we're really happy to have Devin Thorpe here to discuss his book, How to Make Money with Impact Crowdfunding. Now, before we get into it, just a little bit about the CFPA. We're the leading trade association. We represent issuers, investors, vendors, really the whole ecosystem in the world of regulated investment crowdfunding. We've been doing this for a dozen years. We have a very enthusiastic group that works together to try and advance the industry, to educate people, and to advocate for the industry. We want to thank our sponsors, our webinar sponsors, who makes this webinar series possible. That includes Crowdfund Holdings Innovators and Dealmaker, and really appreciate their support in our webinar series. Now, if you're interested in regulated investment crowdfunding or CFPA, we'd encourage you to join as a member to get involved. You could go to www.cfpa.org or www.crowdfundingecosystem.com to learn more, to engage with people, to really participate in some of our activities. We hold webinars about monthly, but we're also going to have a summit in October. So please save the date, October 22nd, 23rd. To have an we'll have an in-person summit in Washington, D.C. at that time. And if you'd like to participate, please let us know. Before I turn it over to Devin, just to let you know that if we have some time at the end, we will take some Q&A, but he's here to talk about his book. And let me read a little bit of background about Devin. He is the CEO of the SuperCrowd, Inc., a public benefit corporation helping diverse founders and social entrepreneurs raise capital via impact crowdfunding. He is also a best-selling author who calls himself a champion of social good. His most recent book, How to Make Money with Impact Crowdfunding, is an investment guide for everyone. He has produced about 1,500 episodes of his show featuring luminary change agents, including Bill Gates. And his book, which has been read over 1 million times, helps people to do more good. He has helped nonprofits raise millions of dollars via crowdfunding, and he draws on his experience as an investment banker, as a CFO, a treasurer, and as a U.S. Senate staffer. He earned his MBA at Cornell University, and Devin says that, frequently finding himself on airplanes, he is grateful to be middle seat sized. So thank you, Devin. I would just add, though, that in the field of investment crowdfunding and impact crowdfunding, he's a giant in the field. So we're really pleased to have you, Devin, join us. And with that, I'll turn it over to you to go ahead and talk a little bit about your book.
Well, thank you so much. It's an honor to be here. I'm grateful for the opportunity. And you pointed out correctly that the CFPA is the leading trade association in this space. It's the only genuine one, but a deep legacy in the space, and I'm honored to be invited today. I've served on the board for a number of years, and I'm grateful to have the opportunity to present today. So thank you. There are three key things that I'm going to try to share today. One is how to match market returns with your impact crowdfunding investments. And this is important. If you can make the same money you're making elsewhere, why would you do it elsewhere? And I want to talk about why it's important to do this. It's tempting to think of your impact crowdfunding investments as philanthropic or just the way you support friends. I'm going to talk about why it's important for you to make money doing this. And for those who are new and interested, I'll share how to start with just $10. I think it's important to note that I'm sharing information and educational content. I'm not a financial advisor. I'm certainly not your financial advisor. My book is available at 4sc.fund/book. It's easy to find. I encourage you, if you have the patience to do it, to go to a local bookstore and ask them to order it in. They can all do it. It's easy for them to order it. It won't likely be on the shelf, but you can order it online here at 4sc.fund/book. At the end of our discussion today, I'll tell you how to get the free ebook let's talk about stock market returns. You know, the reality is that over the long haul, very consistently, the stock market delivers a return of about 10%. Now that varies widely, right? Sometimes we'll have a year where the stock market goes up 30%, and then the next year it'll go down 30%. So tremendous variation. The stock market, which is the highest returning opportunity for most ordinary investors, is a risky place to invest, but the alternatives often are almost less appealing. But let's keep in mind, some of you are young enough not to have fully appreciated what happened, but between October 9th, 2007 and March 9th, 2009, so about 18 months, the S&P lost 56.8% of its value. That's a huge drop. So imagine that you had $100,000 in your 401k invested in the stock market. At the end of that period, you had $44,000, not $100,000, not $100,000. So this is the stock market can be a scary place to invest. If you want a little less risk, you can invest in bonds. And over the long haul, bonds yield about 6%. But the reality is, even in today's relatively high interest rate environment, it's not quite that high. It's closer to 5% than 6% for good quality corporate bonds. Now, and it's important to note that they're not risk-free. You're not absolutely guaranteed to get your money back. You know, a lot of people bought GM bonds in the 90s and then didn't get their money back at the end because GM went bankrupt in 2008. So it is not a risk-free place to invest, even though yields are lower. So it's important to recognize that what we think of as the market is delivering risky returns in a fairly modest level, right? People are not getting rich overnight, generally speaking, in the stock market. So that's the context for our discussion. Now, let's talk about what is impact. There's always an impact from our investments, but it's not always what we think. But when I talk about impact, I'm generally looking at the positive social benefits, environmental benefits that may result from an investment. And you know, there are some powerful examples. So you could reduce carbon emissions, you can improve global health, all kinds of different things can result. Regulated investment crowdfunding is governed by the same regulators that govern the marketplace for stocks and bonds, the Securities and Exchange Commission and FINRA. And there are nearly 100 companies registered to do it as either portals or broker-dealers who've obtained permission to do regulation crowdfunding and or Regulation A offerings to the crowd. So just under regulation crowdfunding, over $2 billion has been raised from about 1 million people. This is a real marketplace. I think most of you are probably here because you're interested in this place and are well familiar with that. When I talk about impact crowdfunding, I'm talking about the intersection of impact investing and investment crowdfunding, right? The regulated investment crowdfunding that we talk about so much at the Crowdfunding Professional Association. Now, let's talk about why it is important to make money. The profits correlate with impact. You know, it's not one-to-one, right? Not perfect, but there is a correlation, a positive correlation. Also, your profits can get recycled, and profits can justify increasing your allocation. Let me talk a little bit about each of these. But let's just step back for a second. I have had the opportunity to meet Bill Gates in person, interviewed him, had him on my show, even had a follow-up call with him later on. Really quite liked him. he is among the very richest people on the planet to this day, well-known philanthropist. But when he invests, and when the nonprofit Gates Foundation invests, it seeks to maximize returns. So why is it that one of the wealthiest people on the planet, who is at heart a philanthropist, is so focused on returns? I think it's for the reasons we're talking about. And let's be clear, you probably feel like your money needs to work for you. You probably feel like you have less money than Bill Gates, and probably feel like you need it in order to accomplish the things you want to do in life. You don't feel like you have money to throw away, money to burn. You may do philanthropy. I encourage you to do that, but I recognize that your investments need to make money for yourself, and that's totally legitimate. I don't want to tell you you're doing it wrong because you feel like you work hard for your money and deserve to have a return. I think that's legitimate. But look, there are additional reasons for why you should make money on your impact investments. One is that profits correlate with the impact. If you invest in a business that has great dreams of social impact, but can't stay in business, that business won't have impact. It won't do any good, and your investment won't achieve social impact because the business fails, goes out of business. There's no impact there. So just from a pure having impact space, I'm not saying you can't, you should ignore impact. I'm saying you also need to look at whether the business is viable. And that means a lot of different things in different circumstances, right? A startup might be 2 or 3 years before it'll even get revenue. A restaurant might have been in business for years. And so you might be looking at very different criteria under different circumstances for what is viable, what has the right potential, but nonetheless, you want to be considering whether or not that business can deliver profits as well as impact. Another reason that you want to have profits is that it allows you to recycle the cash flow. If you invest $100 and get back 120, now you can invest 120 in the next deal, and your impact can grow. It can grow essentially without limitation if you are being wise and investing your money profitably. So that recycled impact can be a perpetual motion machine that's perpetually generating impact. And a third reason, and this one came to me the slowest and yet is, I think, the most important. And that is that once you are seeing your own ability to generate profitable investments, to make profitable investments via regulated investment crowdfunding, then you can allocate more resources to it, right? You may be inclined to start small, start with $10, start with $100, but when you begin to see that it works and it generates profits and financial returns, that changes the game. And you begin to think about how you could allocate maybe some of your retirement savings into this kind of a program so that you can, if you can match those stock market or bond market returns, depending on your preference, golly, you may be able to have tremendous you may have a lot of money that you can allocate this way. Okay, it's important to understand that there are a whole variety of investment types in this space, and investing to make money requires you to understand some of these things. So I'm going to kind of blaze through 6 different kinds of investments. And the first is simple term loans, right? Think about your car loan. Almost all of us have had a car loan at one time or another. Most of us still have a car loan. So you can invest in loans that look a lot like a car loan. They may or may not be secured, depends on each deal. So there may or may not be an asset like a food truck or real estate that backs those loans. So you need to check and make sure you understand what the case is. But these deals are pretty easy to understand. And it's if you can understand how a loan works when you're borrowing, you can also understand how a loan works when you're investing. There's another kind of loan that's increasingly common in the world of venture finance, including with early stage businesses and some growth stage businesses. So I've seen it with folks who are, for instance, operating a food truck and wanting to build a brick and mortar store. They'll oftentimes use something like this, a revenue-based financing deal. And so it's a loan where rather than state an interest rate, they say they'll give themselves some span of time, 5 to 10 years usually, wherein they will promise to return a fixed amount of money. So maybe you give them $100 and they promise to return 150 or promise to return 200 within a period of time, say 5 to 10 years. It's a little bit harder to determine what your ultimate returns will be, but if the company is successful and grows profitably quickly, you may see your money come back at a much higher rate of return than you would get on a typical loan, a typical term loan like we were just talking about. Now, there are 4 other investment types that are all more equity-like, despite some of their names. A convertible debt instrument is typically used as a structure for an equity investment. It's a weird thing, and so if you're new to this space, it may strike you as odd that you are investing with an equity mindset in a convertible note, but the convertible note is there as kind of a backup if things don't work out. But the real plan is to convert the note to equity in a growing, thriving business. And the note structure is there as a backup if things go wrong. A simple agreement for future equity, SAFE, is a simpler form of the convertible note that lacks some of the protections of the note. It lacks an interest rate, but generally offers the investors some weak claim on assets in the event of a liquidation, while giving them an opportunity to convert that document, that agreement, that simple agreement for future equity, into actual common or preferred stock later on down the line, usually triggered by a big financing round. You can invest directly in preferred stock, and there are a lot of offerings of preferred stock available through crowdfunding. And preferred stock is what it sounds like, but it's more meaningful than you might appreciate. It's not just a little bit better than common stock in many ways. It's a lot better. In most liquidation scenarios, even some very successful liquidation scenarios, the preferred stockholders may do a lot better than common stockholders. So it is a really savvy way to invest in a deal. That said, a lot of companies are issuing common stock, and there are a lot of reasons why that makes sense. One reason is that it is a way to support founders. It is a kind gesture, in a way, to invest in common stock, kind to the founders. It is also a way to keep the cap table structure, the structure of the organization. In a small business especially, it may make sense to not burden the company with a complex capital structure, right? Keep it simple. All the owners have common stock, whether you're founders, whether you're an employee who buys in or an investor, everybody gets the same. That may make sense in some circumstances, and it may make sense even as an investor. Now, there are 3 basic strategies. So those are the six kinds of investments, the 6 instruments that I see that are pretty common in the crowdfunding world. Now, there are 3 strategies that I see people employing in the crowdfunding space, and they all have some appeal. And so we'll talk about each one of these for a few minutes here. First, we'll talk about yield. and then we'll talk about a venture capital type strategy and what I call a hybrid strategy. So when we're talking about yield, we're talking about focusing on only term loans with a structured interest rate, right? A designated interest rate, that yield strategy where you invest $100 and get loan payments every month or every quarter. It may vary. Sometimes it's even just one annual payment, but there are a lot of different opportunities around this. But I'm seeing a lot of term loans offered by on the SMBX website, a lot of term loans on Honeycomb Credit, but also on Raise Green, very common there, and very common on Climatize. So there are a number of places, and there are probably others, right? I don't mean to limit it, but those are the places where I have seen and invested in term loans, and it's a place where you can get remarkably high yields. So let me put this into some perspective. So I've seen in recent months offerings ranging up to 14% interest rates. Now, 14% is a pretty darn high interest rate. It probably correlates with a risky loan. That's a reasonable thing to consider. So I certainly wouldn't recommend putting all of your money into one 14% term loan. It's a lot riskier than a bank deposit, right? That interest rate is there for a reason. But if you build a portfolio of loans made to a lot of different issuers, you may find that you're able to get most of that money back right on schedule. Some may be a little bit slow paying, but very few people will pay nothing, right? It's going to be very rare in this yield marketplace that someone borrows money and never pays you anything. So the risks look to me to be lower building a portfolio than a portfolio of stock market investments. But what did we already notice about these loans? With interest rates at 10, 11, 12, 13, even 14%, this yield strategy may deliver a return higher than the stock market consistently over time, and at the same time offer you lower risk. Now, it's illiquid. It's going to be illiquid. In the stock market, true finance professionals don't think of the stock market as being truly liquid. And the reason is you don't know what the price is for your stock, but casual investors think of it as being liquid because even though you don't know what the price will be tomorrow, you can be pretty confident that there is some price at which you can sell all of your holdings. 2008 and 2009 taught us that that price might be a lot lower than the price where you bought the stock, or at least a lot lower than where it was trading last week. But in investment crowdfunding, when you are using a yield strategy, your investment is illiquid. The good news is you may be getting monthly or quarterly payments so that there is cash flow, even though your investments are not redeemable, not marketable. You're kind of stuck with them for the long haul. Okay, so here's kind of the magic thing. If you just do $100 a month and then reinvest everything that you get back over the years, plus adding $100, after 2 years, you'll have $2,600. Not very exciting. You put $2,400 in and you've got $2,600, so you made $244. Big whoopee-doo, right? But after 10 years, you'll have put in about $12,000 of your own money, and you'll have $20,000 in it. So you had $8,000 of returns. That's pretty interesting. Okay, now after doing this for 30 years, you've put in $36,000 and you have $226,000 in the bank, $190,000 of profit. So over time, this can be meaningful. From small things, grow big things. Just give it time. And so if you are in your early 40s or younger, looking at retirement around age 70, this can be a really relevant strategy. And if you're older than that and have some capital to allocate to this, you could also use a yield strategy. This can be a really meaningful part of your retirement planning. Okay, so let's talk about a venture capital strategy. And here I want to jump in and highlight something. Venture capital returns vary dramatically. The biggest venture firms in the country consistently get better than stock market returns. But if you're an ordinary investor like me, you're not invited to that party, right? There is no way for you and I to get our money invested in the best venture funds. It's not an option. And in fact, most of us are excluded from investing in any venture fund. But we do see that the best funds do return very high returns. The worst funds do worse, not just worse than the stock market. The worst funds consistently lose money, right? So there are a lot of funds, not just investments, funds that lose money in the venture space. So you have to recognize this strategy can be risky. It may be challenging to beat those returns. But what works in our favor as we approach this is that funds take massive fees customarily. They take up about a 2% fee. Now, you think about that, that doesn't sound too bad, 2% a year. But what that means is that over the life of a fund, say 7 years, that's about 14% of the money goes out in the annual management fee. Plus they take, the fund managers take a carry, 20% of the profit. So it really, that's one of the reasons they fail to deliver profits so often. The worst funds, they take those fees and they can't even overcome their fees. Okay, so when you're investing via regulation crowdfunding, you may be able to avoid most of those kinds of fees, right? You're investing directly, you're not paying a manager. So that may work in your favor. So the key thing to appreciate when you're using a venture capital strategy, whether you invest in safes or convertible notes or preferred stock or common stock, whenever you're investing in any of those kinds of things, you are looking at trying to see appreciation rather than yield. There's some rare exceptions where you might invest in a deal where there will be dividends paid on the preferred or the common stock. But generally speaking, we're talking about looking for appreciation in those in that way. So you can get these returns from buying the common, whatever form of equity you want, and then you get those returns over time by the appreciation, the increase in value of those shares. It's a little bit harder in under regulation crowdfunding to invest in later stage deals. There are not a whole lot of those offerings yet in the marketplace. I am hopeful that as the market continues to mature, that we will see more and more companies doing what is often called a community round after raising some venture capital, which means some of the venture capitalists have helped de-risk the deals, and we can invest in the growth stage. So I'm hopeful to see that develop over time. We're not seeing a lot of that yet, but some. Keep in mind that venture capital strategy is very long-term, and given right now that the market is sort of skewed to earlier stage opportunities, it probably is even longer term than a typical venture fund, which usually seeks to wrap up in 7 to 10 years. It could be a little longer. in managing your own portfolio of venture style investments. So keep that in mind. And one of the key things to remember here is, depending on the stage of investment, most venture funds recognize that their money will be invested most of the time in companies that will deliver either zero in return or very little, and they will lose money on the investment. That's a sad reality. Now, what offsets that? How do the best fund managers make money when they are losing money on every investment or on many of their investments? It's because once in a while, they invest in a deal that returns tenfold or 100-fold, and it makes up for all the other losses in the portfolio. And so they're able to take a portfolio of $100 million and return to investors $200 or $250 million at the end of 7 to 10 years by having one or two companies in the portfolio that delivered massive returns and created most of that value. So that's kind of how that works. And so that's how it will work for you. You'll invest in lots of deals, and most of them won't work, but some occasionally will. So that's why diversification is so critical. And this is why I would make this important point. If you think you're using a venture capital strategy, but you've only invested in one deal, you are not using a venture capital strategy, you are gambling. And that's on you. That is not a wise investment strategy. Okay, so let's talk about the hybrid strategy. What is the hybrid strategy? The hybrid strategy is what most of us do, right? The reality is most of us allocate some of our investment dollars to yield and the rest to more of a venture capital approach. But there's a third element that comes into play here, and this is one of the exciting parts of being a little more flexible and using this hybrid strategy. You can not only allocate money to term loans that have a stated interest rate and to equity deals where you're hoping for great appreciation, but you can also look in this interesting middle space where we have these revenue-based financing deals that are becoming more and more common. And so we see people promising 1.5 to 2, sometimes even 3 or more times your money in return if you will invest now. And it depends, if they properly evaluated the marketplace. If they are a pre-revenue company, they might offer you 3 or 4 times your money back. That's not as much as you would get if you were buying equity in that company, perhaps, but you don't have to wait for them to sell the company. As they generate revenue, they're going to start paying you back. That's a very different risk profile than investing in equity in that same company and hoping that they sell that business or get to an IPO at a time when you can really profit from it. So it may be just as wise to invest in their revenue-based financing notes. But other companies, we see every stage of company using revenue-based financing, especially when they have some prospect for meaningful growth. And so these are an exciting investment nuance that you get to add that really only works if you're using this hybrid strategy. Like I say, most of us, I think, who are actively investing in the crowdfunding space are using to some extent a hybrid strategy. There are a few purists who are sticking with the venture capital strategy and a few others who are sticking with the loan, the term loan strategy, the yield strategy. But most of us, I think, are playing in this middle. And so we can add these revenue-based financing loans to our deal. Okay. Now, the real secret to success in investing is the due diligence. And this is a scary reality, but the data is unequivocal. If you are not subjecting your investments to some scrutiny and some meaningful scrutiny, there is too good a chance that you'll just be scattering your money around and you won't get the returns you want. Good due diligence is just vital to helping you get the returns. If you can't beat the market, I'm pretty sure you can't beat the market if you are just casually investing and not doing your due diligence. And so what is due diligence? It's the research, right? It's the research you're doing to decide whether or not an investment is a good investment. Now, there are a few of you who may be watching who are saying, well, I don't know how to do that. And that's totally legitimate. I understand. There are all kinds of free tools out there to help you learn. I'll share some today, but there are lots of free and affordable tools to help you learn how to do better due diligence. My theory, though, is the best way to learn is to just start doing it. But since you're learning, that's why I think it's so important that there are companies that are helping people invest as little as $10, right? Because the due diligence exercise is the same whether you're investing $10 or $10,000. So start with 10, begin doing the subjecting your investments to the scrutiny that a real live fire practice round justifies, and then you'll quickly learn by doing. So I have a list, kind of a due diligence checklist that I have created that I use with our Impact Cherub Club. We meet every month to look at investments in crowdfunding. And if you visit diligence.impactcherub.com, you can check out our due diligence checklist that we pretty consistently use in making investments. Now, it was at a CFPA webinar that I really became converted to the importance of due diligence. Brian Belay, pictured here, did a fabulous job, and that recording is still available on the CFPA website. I should have put the link here on the presentation, but it was fabulous. I encourage you to go check it out. But one of the key things he demonstrated, and Brian is the secretary, past treasurer, the 2026 president of the CFPA, but he proved to me with his presentation, based on some real genuine data and research, that due diligence leads to higher returns. Not just a little bit, it's dramatically higher, right? People who are doing good due diligence are getting multiples of the returns that the poor due diligencers are getting. And so it's just vitally important to begin learning this discipline of due diligence. Now, on small investments, some of you are saying, wait a minute. It makes sense to spend hours and hours doing due diligence on a $40,000 investment. It doesn't make sense to do that for a $400 investment. I'm sympathetic to that argument. There are some things that are changing, right? One of the realities is that inherently in the world of regulation crowdfunding, due diligence is a little bit easier because the SEC and FINRA require disclosure of a lot of information. You don't have to tease it out of the company. It's there. It's on the website. You can go read it. So you can start simply by reading all of the disclosure on the crowdfunding website. You get a lot done that way. You can also use AI tools. I've created some, others are creating others, but I think AI is going to completely change the way we're doing due diligence. That's exciting to me because I think that it allows us to make this very efficient. I think Brian Belay and his team at King's Crowd, Chris Lustrino, the CEO, told me recently in an interview I had with him that they are using AI as part of their due diligence process. And so that is, I think the future is AI. That's exciting to me. A second point of leverage, King's Crowd offers due diligence reports. I think they're $25 a piece. That may not make sense if you're making a $10 investment, But if you are managing a portfolio, you can subscribe to get all of their reports for a pretty modest fee. So, and I may have that pricing wrong. So check it out. Check it out. I'm not King's Crowd. I love King's Crowd. I visit King's Crowd almost every day. It's an incredible resource. We're also at the Super Crowd. I'm starting a practice this week. This very week, we'll be starting a new practice. I'll be sharing my pick of the week based on my due diligence from the new offerings that are out each week. We publish a list of new offerings each week, and I'll look at all of those and pick my favorite and share that on Fridays with our newsletter, but only with our paid subscribers. Okay, another option for accelerating and making your due diligence easier is to join an investment club. And there are lots of them going on, many focused on local investing. So if you're interested in investing in your local community, that's an approach. The Impact Cherub Club meets every month, and we would love to have you participate. Check it out at impactcherub.com. And we are excited to just help people do more investing. And by sharing the due diligence load and sharing our insights, our industry insights, and it's amazing, people who don't think of them as experienced investors can oftentimes bring tremendous value. What a teacher knows about, pre-K education is vitally important when you're looking at investing in a chain of preschools, for instance. So that teacher may not think of herself as being an expert on investing, but suddenly we're looking at something where her expertise is vital. So having a club of diverse people and diverse backgrounds makes a really efficient way to scrutinize and do due diligence on investments so that you can get better results. Okay. Now, I'm going to take a minute here. I told you that there is a secret way to start with $10. And there are, I think I saw one on Net Capital recently. It was, I would say, a crappy offering, but it literally had a minimum investment of $1. But so you can check Net Capital too. But SMBX, as a policy, allows all of their offerings start at $10. So by policy, you can go and invest $10 every day, every week, every month, whatever pattern you want, $10 at a time on SMBX. And what I love about SMBX too is that investors, if you link your bank account and do the ACH transfers instead of credit cards, you pay no fees. So you invest in dollars, pay no fees, get the money back, pay no fees to get it back into your checking account as that money comes back. Holy cow, this is magic, 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 magic. So I love SMBX. Climatize is doing the same thing. And Climatize, actually, they advertise that you can start at $10, but the reality is their lower limit is $5. You can start with $5 at Climatize. So if you want to start small so that you can begin to dabble, learn, and experience, you can start with these websites right now so incredibly affordably. I encourage you to check it out. Now, here's how to get a free ebook copy of my book. You visit 4sc.fund/ebook free. Ebook free. 4sc.fund/ebook free. You can get my book. That concludes my presentation. I'm happy to take questions if there are any bodies interested in asking some questions.
So, Devin, let me ask a question. You mentioned that one potential approach is to look at revenue-based financing. And so can you name any specific examples or at least talk about the types of businesses that are really good candidates for that type of financing?
Yeah. I'm seeing a wide range of companies using these. So it's pretty common for people at a growth hurdle. So for instance, the food truck operator or the caterer who says, I've got this legacy business. I'm making hundreds of thousands of dollars a year in revenue. I've got a legitimate business. I want to open a restaurant where I can take my recipes, my proven expertise, and move that to a fixed location. Well, that's a big, giant change. And so rather than doing a term loan that might lock them into payments that could be potentially unaffordable, doing the revenue-based loan gives them a lot more flexibility for that hurdle. So in those circumstances, I'm seeing, promises of 1.5 to 1.6, sometimes 2, and over 6 to 7 years. So those returns, depending on how it plays out, are probably comparable to the term loans that we were looking at like SMBX or Honeycomb, where you're seeing loans in the range of 11 to 13%. So it's probably in those ranges. That said, we also see some true startups are using revenue-based financing. And so they're coming to the market and they're saying, instead of giving me equity, give me a revenue-based deal and I'll give you 3 or 4 times your money back. But you recognize, this may not go well. And there may not be anything, but you don't have to wait for me to sell this business to get your money back. You're going to start getting your money back when I start getting revenue. And that's a very different equation. And you could imagine that if you were looking only at those kinds of deals, you could actually come pretty close to getting venture capital portfolio type returns, because it would be so common that people would at least pay you something, right? And you might frequently get your money back. And then occasionally you'd get 3 and 4 times your money back, and your portfolio would look a lot different than those folks who hold equity for 10 years and then get, either no money or half their money back. It's actually a pretty reasonable thing. So it's an exciting place. One of the issuers, one of the tragedies that's recently happened was Mainvest was really, they loved these revenue-based financing deals, and Mainvest announced in the last 2 weeks that they would be shutting down. In part, one of the dynamics there that we haven't talked about, Brian, is that WeFunder has really leaned into. They hired Justin Renfro specifically to build their revenue-based financing portfolio, and Justin's done a great job of recruiting issuers to WeFunder using that strategy. So it's a wide, diverse, opportunity there, and I love the structure.
So a lot of the people who are attending today are attending because they want to learn how to make money with impact crowdfunding. Can you maybe talk just a little bit about how this type of financing tends to be more founder friendly than venture capital, in contrast to the terms that venture capital? So while people can still earn a return, they're also, in a way, it might be again, speak to that aspect of it if you could.
I think that's an important thing. One of the things that happens in the venture capital space is that it's almost exclusively structured as preferred stock. Even the early stage folks who are using safes or convertible notes, those are all designed to convert into preferred stock. And let me give you a really simple scenario. I'm gonna do some math, and I apologize, but this makes the point. I hope you can follow along. But let's say that you have a situation where venture capitalists have put $5 million into the business with preferred stock. Now, let's say that the business sells for $2 million later on. Well, forget they go out of business. But let's say that the business sells for $2 million later on. It's not a happy day for anybody. Do you know who gets the $2 million? Right? All $2 million goes to the preferred shareholders. The founders get 0. So the founders who've been working on this business heart and soul for all that time get exactly 0. In the event that the business sells for $5 million, the founders still get 0. In this depending on the terms, it may or may not, but depending on the terms and what, interest rates and dividends that may not be required on those preferred shares, you could sell that business for $10 million and the founders would get either little or nothing. The founders have to sell that business for a crap ton of money to get anything out of the venture capital marketplace. Now, if they had used instead a scenario where they were using the revenue-based financing, for instance, they'd have paid back the 4x, they'd have us out of their hair, and the founders, in theory, could own 100% of the business after paying that off. And so if they sell it for $2 million, they get all $2 million. They sell it for $5 million, they get all $5 million. If they've got to pay off some of the balance on the revenue-based financing notes, they could do that. But it is a very different dynamic that can, and of course, it's much more founder friendly oftentimes to simply do a loan, right? Who wants to have an equity ownership in a business that a founder never intends to sell? What good is that, right? You don't want to force a mom and pop shop to sell. They may want to leave that to the kids. The kids may be excited to inherit and take the business. So it just doesn't make any sense. So using a term loan may be a very founder friendly thing. And common stock, as I mentioned in the presentation, very founder friendly. That's its primary calling card. And safes and convertible notes that convert into common stock are more common in the crowdfunding space than in the venture capital space, where it's just never, it's never used. It always converts into preferred. So anyway,
Right,
I hope that addressed your.
No, it does.
question.
It does. I think it's nice to provide the contrast of different types of financing, not only for the investor types, but for founders who are trying to do their own diligence about
Yeah.
what may make the most sense for them. So, well, Devin, this has been great, fantastic. Really appreciate you sharing your expertise and time. I hope everyone will go and go to that link. I think the link for the book was put into the chat, and where they can go to 4sc.fund/book to get a copy of your book. Hope they'll read it. These are great themes, great messages, and really appreciate you sharing this expertise with everyone and giving us some tips on where for as little as $10 we can go and start getting a return on our investment as well. So
it is so fun.
yeah, thank you. Thank you, Devin, and thanks for all that you're doing for
Thank you,
as
Brian.
well. So
Thank you very much for the invitation. I appreciate it.
okay. All right. With that, we'll close down for the day and hope everyone will join us for our next webinar when we have a chance to announce that. Go to cfpa.org or crowdfundingecosystem.com to see our full events list. Thank you, everyone. Bye.